I'm thrilled to be up here with Jim Moloney, the newest head of corporation finance at the SEC. You're somewhat of a celebrity for all of us capital markets lawyers, and very excited to hear what's in store. But just to give you some guideposts for what we'll cover for the next 40 minutes or so, we'll talk a little bit about just public company disclosure reforms generally. Then we'll move to M&A, obviously the focus of this conference, and then we'll end it with IPOs. But before we get to that, what I'm really dying to know, Jim, is you've had a long career. You explained to me you were at the SEC in the 80s, which I don't really see how that's possible. The part I'm more familiar with is the fact that you have been a corporate partner here in California, like so many of us, for at least a couple of decades, and you've chosen to go back to the SEC. What made you want to do that?
Well, thanks, Sarah, and thanks for having me here. It's great to see so many great people in the audience. So yeah, I started, I guess, as pre-law at Skadden for about 6 years. And I was in the 80s, and then law school in the 90s early, and then SEC Corp Fin right out of law school, and worked on some rulemaking. I started in the trenches and worked my way up to rulemaking in the Office of Mergers and Acquisitions. And somebody one day said, Jim, do you want to work on rulemaking? And I didn't know what that was. And they said, oh, it's going to be great. You're going to love it. And this is before the Department of Labor and the labor laws. So they said you do your day job during the day, and then starting around 5:30 at night, you would work on the rulemaking. And I was in there till like midnight, and then doing my Georgetown Masters at night. So it was an exciting time back then, and I think it was like Clinton was in office, and they had all these folks parachuting in, who had worked on somebody's campaign, and Reg MA turned out to be, in my opinion, a success in that, unlike the aircraft carrier, the Securities Act offering reform, it was just too large for people to get their head around. It seemed too regulatory, and that there was a lot of people who, I guess, knew the laws and didn't want that much of an overhaul with the rules. So it worked out great. And then I came to my private practice. I joined Big Law, Southern California, Gibson Dunn. Started as an associate, and then worked my way up, made partner, co-chair of the practice group, Securities Regulation, Corporate Governance. Worked with hundreds and hundreds of companies, clients, boards in 1 year. And I don't know, I guess it was last May, the phone rang, and somebody said to me, would you like to throw your name in the hat? And a lot of people threw their name in the hat. I mean, we all do. You get an opening. And, one thing led to another, and by Labor Day, they onboarded me. I'll cut to the chase. And why? To answer your question, why? I saw it as a unique opportunity. I think that we all look at the regs and the rules in the public company marketplace, and it's just, over the years, it feels like there's like 30 coats of paint on a piece of wood. And you hear about the cost of going public, the cost of the disclosures. And I, like everyone in this room, looked at the Reg Flex agenda, and it was like 22 rulemakings on tap. And I said, what an opportunity to come back where you basically have everybody on the same page. Some might call it deregulation. I would call it sort of applying common sense. There's just some of these rules on the books that are so old and just in such need of updating. The chairman uses this ACT, acronym, and it's like advance, clarify, and transform. I just look at it like, get it so that it works, because you see people like trying to comply, and there's a rule, there's an exception to the rule, there's an exception to the exception to the rule, and it just creates such a drag, such a burden. And I think some of the earlier panels mentioned, the law should not be static. It should adapt to changing times. And with this, when you look at AI and you look at blockchain and you look at tokens, this is really like, I don't know, many of you here, I'm sure you remember, before computers, before the internet, before you got an email, and everybody was confounded back then in the mid to late 90s, prior to the dot-com boom. Well, how are the securities laws going to work? How are they going to operate in an internet world? How do you do a road show on the internet? And then, of course, there were no action letters like IPO.net and the LAMP Technologies letter. And we all managed to figure out how to apply the securities laws in the internet. So now we have to do it with AI, we have to do it with chain, we're going to have to do it with 24/7, 365 trading and tokens. So it was that excitement that drew me back.
Awesome. Well, I know you're very entrepreneurial and willing to try things and see how they go. Why don't we first start then with our first topic in terms of public company disclosures. From what I've heard you and from Chairman Atkins say, is you're really embarking on a huge spring cleaning or decluttering kind of situation, especially with Reg SK, which of course, for anyone who isn't aware, Regulation SK is really the backbone for the vast majority of disclosures. Can you give us a sense of scope for where that's going?
Yeah, I think everything's on the table, and I've said this at other conferences publicly, and while I'm at it, I should say these are just Jim's views. Not the commission, not the chairman, not anybody. When I go to these conferences, I say, this is just Jim. This is what Jim thinks. I got back there, and I'll be honest, most of the rulemakings were in the pipeline last fall when I arrived. Credit to acting Chairman Mark Ueda. He had the foresight to say, let's not miss a beat. Let's get everybody working on these things, start drafting them. And so there are literally 15 or 20 releases, ready to go. And there's a lot of press coverage about, what's taking so long? Why are they not all out? There is this elaborate process to get rulemaking through. And I think, Eric Girdings here, Freshfields, he was the former. He knows this. There is all kinds of OIRA today, where you have to send it to them. There's DERA with the statistics and the data and cost-benefit analysis, because we live in a litigious world. So you just can't put 20 of these releases through the eye of a needle all at once. They have to go one at a time. And so to your question, Sarah, SK, it's SX. And the chairman realizes that to take on all of that, it's not just one little item, And I joke with people in the building when they say to me, Jim, you're really thinking big. You're thinking outside the box. And I say, well, I didn't leave my job, take a 90% pay cut, leave my wife behind, move 3,000 miles to DC to move one line or one column in an exec comp table. That's what they did before. We're looking at doing basically what we did in Reg MA. For those that don't know Reg MA, before, it was set forth.
You were the author of Reg MA, right? Am I right
call
about
myself
this?
the monkey scribe. I was the monkey scribe. This was the 90s, and somebody said, write it. And I said, what do you want me to write? And they said, we don't know, just write something. So all of us that ever try to get through writer's block, you just start doing an outline, you start making suggestions, and then people above you will come in and say, no, yes, maybe, a little more of this, a little more of that. So with that background and experience, you're looking at SK, which was just like Reg MA, where the disclosure requirements were all over the place. You had to go through all different forms and rules to figure it out. And what we did with Reg MA at the time was put item 1000, 1001, 1002, 1003. So it was just kind of cleaning up and putting all in one place, easy to find, the disclosure requirements for any kind of tender offer, proxy contest, going private transaction, merger. And so that's what we're doing with SK. And we brought in, some of you may know if you're involved in the ABA, Michael Arnold from Cravath. He's big in there, and he works closely with John White, another former Corp Fin Division director. And I brought him in, and we call him the SK Czar. He is the SK Czar. He's working with Luna Blum, who is the Office of Rulemaking Chief. And they have a team of lawyers that are very meticulously going through each item to figure out, okay, is this capturing things that we don't need to capture? And just to give one example, I think there's a line item that says, list all your properties and assets, And if, let's just say you're Amazon and you have a lot of warehouses, do you really need to let? So maybe it's as simple as adding if material. And then a large company that has 1 million warehouses could say, that's not material to a reasonable investor of our company. Somebody just starting out with 2 warehouses maybe it's material. I'm just giving that as an example to sort of, we're not throwing everything away. I say everything's on the table, but we're not giving away the store. And this takes time.
It does. I mean, I think a lot of people in the audience would be really interested if you could say anything more about executive compensation. I mean, just, having been doing this for 25 plus years, my head still hurts every time I have to look through those rules.
On exec comp, that's another work stream, and it's in the pipeline. And I think you can expect, I think it was, some of you know Lona Nelangara, used to work at the commission in Corp Fin, out at the SRI in San Diego. He said to me, Jim, is it going to be like Ozempic level shrinkage? And I said, yes, it could be that and more. It's the sort of thing where you're trying to figure out what's not necessary. And anytime you just keep putting more coats of paint, you end up with a lot of things that are there for no reason. On exec comp, certain things, SOX, Dodd-Frank, Jobs Act, all this is legislatively imposed upon us. So when you go back to clean the attic and the basement and the garage, as the chairman would say, you also have to look at what we cannot get rid of by statute. It's required. But you can look around the edges and say, you know what, 25 or 30 pages of executive comp is over the top. And I think it was Warren Buffett that said, it's all of that exec comp disclosure. It was meant to name and shame and to get people to pay less, and it's had the opposite effect. He did it in his last letter before he retired, went on to, executive chair. Yeah. And so the rules have actually had the opposite effect of what they were intended. And I think we're going to try to get back to basics.
How do you think about topics like executive security or pay versus performance?
Take executive security first. I think for many years it was viewed as, it's a perk. And now we've seen recent events where maybe it's not a perk. Maybe it's important to have security for your top people. If it's important enough to have a risk factor, right, that our top brass is very important. If they get sick or die or get kidnapped, that's a big risk to the company. Maybe that's just the cost of doing business on that. What was the other item you brought up?
Pay versus performance.
Pay versus performance. This is where you kind of get into maybe we have to have a vote on certain things, say on pay. But when you get into the level of disclosure and the fact that there's been these comp consultants that are making millions and millions of dollars studying, and then don't get me started with the peers, who is a company's peer, and then they have a peer for stock price, they have a peer for executive comp, they have multiple different sets of peers. And I think that, when people are not reading the disclosure, that's a problem. And I'll be very honest. I mean, you go around the building, people that review these things for a living in the building, their eyes are brought to tears, and they're getting paid a low salary. You go to the big law, and you talk to the associates that are helping pull this together, they're getting paid 3 or 4 or 5 times. Their eyes are tearing. These are people that are getting paid to do this, and they don't like reading it. Then you ask, does my 83-year-old mother like to read it? No. So what are we doing? We're just creating content.
Yeah.
And I will say, because this is there was a lot of talk here today about AI. Mm-hmm. Some of the critics will say, when I meet with the CII and the ICGN, you can Google or look those up online if you don't know who they are, but, they'll say, Jim, just more. Don't take anything away, more, because AI will solve our problem. AI will take care of all this for us. And I asked a very high-ranking official at a very large AI company, is AI the answer? Uh-huh. Because I'm getting this criticism that AI will take all the data and will make it simple for us. And she gave me a joke, and I hope she doesn't get offended if I share the joke. But the joke was, somebody walks into a bar and says, here's a 3-point bullet point term sheet or document, turn it into a 20-page memo. And AI turns it into a 20-page memo. The next person comes into the bar and says, okay, take that 20-page memo and bring it down to 3 or 4 bullet points so I can understand it. And the answer was, well, you get the hallucinations, you get the garbage in, you get the garbage out. And it's not the answer, at least not now. So if we can get back to basics with what's financially material to the company and not get lost about what certain little subsets of constituents out there are just curious to know. But really get back, I think we all heard, Lori Will earlier, about we just need to be boring. We need to be back to the basics. We shouldn't, keep adding rules because somebody thinks another rule is good and another law and another disclosure item, just because. Because if we ask everybody what they want and everybody asks for a million things, if everything is material, then nothing is material.
I hear you. I think that's music to a lot of people's ears. Really quick, before we leave public company disclosures, we've heard a lot about the fact that companies may be able to go from quarterly reporting to semi-annual reporting. Do you really think your clients are going to do that?
Yeah, that's a funny one because that was not really on the RegFlex agenda when I was doing my junket cross country to DC. But somebody very important did tweet or put a post out there about look into this, consider it.
Yeah.
And then there were a lot of folks that were very critical of it and thought this is the end of the world. And I just describe it as this. It's the cadence. Is it 3 Qs and a K or 1 Q and a K? Mm-hmm. Let's just dumb it down, because semi-annual reporting, and what does that mean? So who's going to do it, if it even comes to be? First of all, there'll be traditional rulemaking. It will be proposed. We'll ask for comment. We'll see who wants it, who doesn't want it. I'm sure we'll get a mixed bag of, views. But let's say we went through with it. Let's just fast forward 2 or 3 years, and let's say there was a semi-annual reporting scheme or regime. It would likely, in all odds, be voluntary. And then who's going to voluntarily do it? Probably not the large multi-billion-dollar market cap companies. It's probably something that might be attractive to smaller companies. And then you would say, well, which smaller companies would be interested in this? If we were in San Diego and not up here in tech, you'd see a lot of life science companies that would say, our business model and mission is to get a drug therapy through FDA drug trial 1, 2, 3. Spending time on MD&A and Qs, and every time you just get done with the earnings call and the earnings release, you're starting to work on the next Q. The only thing that's relevant for companies like that is how much money's in the checking account, and how far have you gotten on these drug trials. Another industry, regional banks, smaller regional banks, companies that are IP, royalty-based, where it's a very steady stream. And for anyone out there, I know this audience is not lawyers, but for those of you at companies that have looked at the Q each quarter and looked at the red line, the track changes.
There's a lot of lawyers.
There's very, very little change in these MD&As. They're just updating the numbers. So I think folks will live, and the guardrails that would be there. Insiders like to trade. Companies like to buy back stock. Financial analysts and others in the marketplace will demand information. You're likely to see, I think, a market practice develop where companies would put out flash numbers. They'd be high level, they'd be on an 8K, and don't worry, the accountants will find a way to charge some fee for looking at and giving some cold comfort to those flash numbers. So I really, for the amount of criticism that I've heard, although I have had some very large companies that are private tell me this might be of interest to them because they dread the idea of having to report on. Think about everybody wanted about long-termism. The people fighting for these Qs are back to short-termism.
Yeah.
I'll stop there.
No, it's okay. We could probably talk about that for a long time.
We could.
Why don't we switch to M&A, since this is an M&A conference? You've been really busy, including this week, dropping some major news on us. I don't want to scoop you, so why don't you talk about what you dropped?
Yeah. So. In the M&A space, and this will give you some insights to what we're doing in the building. I get in there, there's a lot of people, great, smart, talented individuals, but M&A has maybe over the years not gotten the attention that it deserves. It was always exec comp, or it was climate, or it was something else, whatever the flavor of the month was. Given my background in M&A, having now done it for 35, 40 years, I said, there's a lot of things that are long in the tooth that could be cleaned up. And in my practice when I was out in the private bar, had a lot of clients, they want to buy back stock. You know, you can do it through a tender offer, you can do it through an accelerated share repurchase program. If you go to a big bank, it's kind of known as the black box because you don't know what you're paying. Or you can do open market share repurchases, but most will comply with 10b-18. So when I got interviewed, I had an idea. Because they always, when you interview, they say, what's your idea? And I said, my idea is your idea. Whatever's on your agenda, I will do it. You know, meaning, like, you've already baked the Reg Flex agenda. You already have these releases half drafted. I don't want to get in the way of that. But they said, no, but what's your little pet peeve? And I said, a lot of these rules have timelines that date back to the 60s. I mean, even when I worked on Reg MA, S4, people know a merger, S4, there's an instruction in the form that says if you incorporate by reference, you have to keep the offer open or the vote for 20 days, you know. And when I was writing that, when I was the monkey scribe, I said, why are we doing this? And my boss at the time, Maury Oshrov, she said, you know, Jim, I'm just not convinced everybody has a computer yet. You know, there's a lot of people out there who don't have the money or the technology. And here we are some 30 years later. You got a computer on your wrist. You got one in each pocket. You got 2 iPhones. You got a couple of computers at home. You got a couple of computers at work. Everybody has the technological ability. But it used to be you'd have to go to the SEC. You'd have to go to the basement. You'd have to go to the public reference room. And you'd have to look for the document. Information is instantaneous today. You want a stock price? You just look on Yahoo Finance or Bloomberg or anything. So that gets us to the order. So tender offers, all tender offers, whether public or private, need to stay open under the rules 20 business days. Translates to about a month. So if I say to you, I'm going to give you $20 for your share of stock, you would say, okay, when do I get that? And I'd say 30 to 45 days from now. And they would say, well, I don't know if that's a good price or not because of the volatility in the market. We could have another war. There could be another thing with oil. Anything could happen between now and then.
I mean,
so,
look at how fast these companies are growing today. It's
correct.
a whole different company in 45 days.
Correct. We live in a world that changes moment to moment. So what if we said it could be shorter? So we issued an exemptive order. Corp Fin, where I work, has the delegated authority. And we limited it to all cash offers. Could be the issuer buying back stock, less than all. Could be a friendly merger, then it's for all. Private companies, you know, pre-IPO, things like that, you can do it all cash. And there's a bunch of conditions. I won't bore you with them. It's in a 2-page order.
That was my favorite part.
Yeah.
The SEC, I mean, like you issued 2-page, very, very clear guidance. But I know that a lot of people have been welcoming this, but there have been a few critics. Can you tell us more about
I refer to them as, well, they're academics, but I call them the owls, you know, the owls. There's, if you go into their blogs, the owls, the professors have their blog sites, and they've claimed that, you know, we didn't have the authority to do this. They claim that we're going to open up the floodgates for Saturday night specials. For those of you who are like, what's a Saturday night special? You have to go back pre-68, back to the Williams Act. Senator Williams, the Williams Act. There were people that would announce an offer. Sometimes you wouldn't even know who's making the offer, but you knew it was going to be at a premium. So all the stock would trade hands, and so that announcement would start on Friday, and by Monday morning, basically 50% of the stock would have changed hands. And so the Williams Act and all those tender offer rules were designed to slow things down, give people information, and very well intentioned in 1968 up to 1984, and then we sort of settled down with the all holders, best price rule, and all this stuff. But today, if there was an offer, you're going to have to prepare and file a tender offer document. You have to announce it. You have to disseminate it. 2 weeks is plenty of time. And if a hostile or interloper, an unsolicited bid comes in, then this 20 to 10 falls away. You have to go back to the old rules. So I don't anticipate a wave of, you know, hostile takeovers happening overnight as they predict. I think they're wrong on this one. I don't know how many tender offers they've done. We all heard today from the antitrust regulators, the state, If you look at the Fed, the HSR, Hart-Scott-Rodino, there's a 15-day period just to, if they don't do anything and clear you without a second request. So there's another example where it's probably not going to be a 10-day. It would, in a merger, friendly merger, it would probably be at least 15 days. If someone comes out and announces a competing bid, you're back to the regular rules. And whenever there's a competing bid, nobody tenders their shares because they want to see if the competing bidder is going to top it.
Right, right. Should we expect more exemptive orders in this area or others?
We're doing it in a couple of different ways. And people often ask me, why are you doing this now? Well, while the rulemaking is coming through the regular way, we're taking calls, we're taking meetings from all groups, law firms, bankers, ISS, Glass Lewis, the PVABs, the proxy voting advisory boards, all the big three, like I said, BlackRock, Vanguard, State Street, the CII, they all come in, they give us their ideas. And what I'm doing is telling different groups, okay, take that, go back, see what we can do. Either add it to a rulemaking that's in progress or think about how we can put out what I call a CFI, a Corp Fin Interp. They used to be called CNDIs, Compliance and Disclosure Interps. Too hard to remember, too hard to figure out where the ampersand goes. Chairman asked me, what is a CNDI? 5 times, because it's a weird acronym. So we came up with Corp Fin Interp, had to change the whole website. Everybody was crying in the building. Search and replace. It's not that hard. And so we did a CFI, for example, on broker search. The rule, 1413, says something about 20 days. You talk to anybody in the industry, proxy, solicitor, info agent, they can get you a broker search done in 2 to 3 days. So why comply with 20 when you can do it in 2 to 3? So we wrote an interp, a CFI, that says, we're not going to send you to enforcement purgatory if you do it in less than 20. We didn't give an exact date. Each company, each situation is different. But if you can get the search done and you have your record holders who you're disseminating to, that's good enough. So it might be in the form of a CFI, could be in the form of a no action letter or an exemptive order. And then the good news about all these things, the naysayers, the people clutching their pearls, all worried that the world's going to end because we did some guidance. If there are unintended consequences, if something goes wrong or awry or we see an issue, the beautiful thing about this is you can tweak it. I can add a condition, I can subtract a condition to this exemptive order if we see issues.
It's very Silicon Valley of you.
Wow.
Beta testing.
Yes, beta testing. There you go. I love it.
Yes.
Yes.
Awesome. Okay. Well, what about the Reg MA itself? Still fit for purpose, or should we be looking for pretty big changes on that front?
I haven't seen many people come in and complain about anything. It seems to be working pretty well. Like 10, 15 years ago, I guess it was 2015, so maybe, 11 years ago, we put out when I say we, the SEC at the time, I wasn't there, but I was on a working group, a no action letter for debt tender offers. And so this no action letter for debt said a tender offer could be as few as 5. They call it the abbreviated debt tender offer. Yep. So 5. I think we're revisiting that. You may see some modernization in that. I love to point to that as an example because that was 11 years ago. And not a single person has complained. So when you do something, when you change a rule and it's working and nobody complains, you got it right. And on Reg MA, I haven't heard a lot of complaints. But if somebody sees something that they really think is creating friction in merger and acquisition transactions, let us know.
Awesome. All right. Well, we can't leave this conference without talking about IPOs. Obviously, there's a lot of chatter right now about IPOs themselves. Atkins has been talking a lot about making IPOs great again. By the way, if you haven't heard it, Chairman Atkins has his own podcast now, which is worth a listen for sure. We've all seen these companies stay private longer and longer and get bigger and bigger. It sounds like this SEC wants to encourage them to go. Do you think you'll be able to?
Yeah, I think on the podcast, I'm next up to bat. So they'll be posting my podcast very soon. I got to sit there and get interviewed by the chairman.
Okay.
And so that's in post-production. It'll be coming out very soon. The first one was with Commissioner Peirce, Hester Peirce. In terms of the rulemakings and what will it do to help IPOs, there seems to be like a misconception. I notice the media, when you say I'm trying to make IPOs great again, they're like, oh, well, then you hate the private markets. And then when he says, well, no, we're going to try to help the private markets, the funds. And then they say, well, I thought you wanted IPOs to be great again. And they try to get you all twisted between, get the chain wrapped around the axle on, well, which is it you're trying to help? And if you step back and think about it, it's an ecosystem, okay? You have companies, public companies, that go private. It's called Rule 13e3. And then they operate without all the extra costs and burden of being a public company for 5 or 10 years, and they come back and they're an IPO. And what you have right now, perhaps, and I kind of laugh at it because I think some of it is disclosure-based. No one wants to be doing, these Qs and the executive comp and then the 404B with the accountants. And there's just so much that's entailed. I mean, years ago in the 80s and the 90s, you will remember, it was like being a member of a country club to be at a public company. There was prestige, there was honor. And now we have the growth of the unicorns, and now they have, $1 trillion market caps, and everybody's saying, is there too much asset tied up in the private? So I like to think what we're doing is really creating doors, windows for the cycle. It's a yin and a yang. Mm-hmm. So if you're private and you're thinking about going public, and there are a lot of companies that are private that don't need the money. We've had some people just come in recently, major investment bank, major law firm, started talking about like direct listings, and how it could be. I think Spotify was like the last one that was big.
The first big one.
The first big one.
There have been
There's
5
been
or 6, Palantir, a bunch, yeah.
But it hasn't been like
it didn't take off
a lot.
Because you can't raise primary capital in a good way, right?
Exactly.
Yeah.
But then there are some companies that just want there to be a very liquid market so that their employees can buy and sell. So they came in and told us about a hybrid direct listing. I'm just giving that as an example of things that we're open to. Just because you've always done it one way doesn't mean it always has to be that way. We're not giving away the store. We're not sacrificing investor protections, but we're looking for ways. So you might say, well, what kind of ways are you looking for, Jim? Yeah. For example, everybody knows like when you're trying to do a filing and there's like 1 million check boxes. Are you an accelerated filer, a large accelerated filer, a smaller reporting company, an EGC? And then if you ever look at any of those law firm client alerts out there where SRC and EGC is like overlapping, and then there's these rules with exceptions to the exception that you might be in this one or you might be in that one, and did you check the wrong box? You could spend a week just trying to figure out what your category is. So we have, if anybody follows OIRA, this agency that basically takes our rulemaking and sends it out to all the other agencies, all the other federal agencies. These have just hit, I think it was like last night, or maybe it was this morning. So we have what's called filer status, which is going to clean up all these statuses to make them simple and easy to understand.
Both at IPO and later, hopefully?
Correct. Yes, okay. Yes. And then there is shelf registration. Just jumping to that quickly, what's happening in shelf? Well, if you go public, you got your S1, you get reviewed, and then, you might want to do a follow-on, but oh my God, we're not going to be S3 eligible for a year or more, depending upon if you're current or not. And then you start thinking about how the 33 Act works. What types of, in addition to capital raising, IPOs, you have resale registration statements, you have universal unallocated shelf, you have at-the-market offerings. There's all sorts of offerings where the way the agency and the rules work today, every single movement of shares, right? It's the old joke, it's not like an unrestricted share has a little red dot on it, a restricted one does have a red dot. We are in this world of registering offers and sales, but I think where we're gonna move, and this is just if I'm a betting man on, Polymarket or Call Sheet, where are we going? You heard it here, so it's not MNPI. is we're going to move to a system where, if you want to think about it, I think there was a commissioner when I was there in the 90s, Steve Wallman, and he was on the Democratic side. And he came down, he was talking to all of us kids back in the day, and he says, you know what you all should think about doing? Was something called company registration. And I was like clutching my pearls, like, well, no, we review S1s, S3s, even back then there were S2s, they got rid of that. And then it was the SB1, SB2, SB3. And I think if you want to think about it, because you're all kind of from Northern Cal and tech, you get a license to drive a car, you get a license to have a short-term rental, Airbnb, right? There are all these things in life where you register once, and then we know who you are, and then we follow what you're doing. So I think that's probably the direction we're going in, is less of this registering things and having to wait for the staff to get it, to look at it, to think about it. It's a full review, it's a no review, it's a monitor. We'll get back to you in 30 or 45 days. Part of the problem with the markets, the public markets, is if you want to go to market, you want to go to market when the market is good,
right,
when the pricing is great. And the problem with the regs now and the rules and the forms is that if you're counsel or if you're an underwriter, you're like, well, we start in March and we get all these things together and we're going to target after Labor Day and before Thanksgiving, but we don't know what the market's going to be like then. And then if you get a comment and then you get this accounting issue, or you do an acquisition and now you don't have the 305 financial statements, you can get hung up. And then you're waiting until the next year. So our rulemaking, if you want to think about what we're trying to accomplish, is make it much more streamlined for a company to access the capital markets. And if there's a false and misleading statement, if something's wrong, there's going to be the plaintiff's bar, there's going to be us, enforcement. We can always come out and get you later.
But that's a pretty fundamental shift, right? To go from registering transactions to registering companies. I mean, it sounds great. That's major.
Look, it's going to be a proposing release. Okay. I think when I met with some folks in D.C., there's the BRT, the Business Roundtable, and another group, Capital Markets Group. They asked me, what's it going to be like? And I said, it's going to be better than your wildest dreams. And everybody got giddy. What do you mean better than your wildest dreams? Because historically, the SEC would just make minor changes, like little course corrections. And what we're going to be proposing are some really dramatic changes. Mm-hmm. I don't know that all the dramatic changes will get adopted, but we want to put it on the table. We want to get feedback because we want to help companies access the capital markets without sacrificing investor protections.
Awesome. One last question in relation to IPOs. So there's also sort of attention the fact that a lot of retail doesn't really get to participate in the upside of these private companies because they are staying private and they're not all that interested in going public. Where do you see the SEC headed on that front?
Now, this gets a little outside of Corp Fin, but I can foreshadow what's happening there. Because in addition to Jim in Corp Fin, we have Brian Daly in IM, and we got Jamie Selway, in trading and markets, the old market reg. So in this administration, in this group of people at the SEC with Chairman Atkins, we meet daily. We are cross-pollinating. If you talk to any of the former division directors over the decades, it was kind of siloed. You stayed in your lane, and there wasn't so much collaboration. I wouldn't even refer to it as collaboration, but knowing what the left hand and the right hand are doing, so that you just sort of are all on the same page, and you're trying to avoid any footfalls. Today, you've probably heard about, there's like a big rocket company that's thinking about going public, right?
Might have heard of that one.
Yes, you might have heard about that one.
I think it's an AI company too.
And if it was with us, as many IPOs are, it's in the DRS, the private, we review confidentially. Yeah. But then you're reading about it in the paper. And then what I'm reading, if you read like Matt Levine and other people in the paper, they're like, yes, the money stuff. There are all these, I'll call them individuals, probably high net worth individuals, but individuals nonetheless, who are claiming to have all these stocks. How did they get these stocks? They invested in a fund, and the fund invested in the company. So retail to a certain degree, maybe not mom and pop, right? Maybe not the guy running the bodega across the street, but People are. So what we're trying to find a way is to get more, I'll call it retail, more individuals access. So there are changes underway in these Form PF and, you know, and there's a whole regulatory review and modernization that is intended to, and, you know, we have to propose some of these things. You can't just wave a magic wand, but to get more access, because if you really want to be diversified, you know, as an investor, it shouldn't just be a public company or a private company.
Right.
This is about the yin and the yang and making the two sides of the table work more fluidly.
Awesome.
Yeah.
We've
Look at that,
just
at a
hit
time.
0. I was going to ask you what legacy you want to leave with your time at the SEC. Can you do that in one sentence?
Yeah, you know, my biggest legacy is not the rulemaking. It's really the people back in Corp Fin who are doing such great work. I have so much fun letting them talk at conferences, letting them work on letters. And one of the things you're going to see, no action letters, exemptive orders, and all these things are having a whole bunch other people's names on it, so that when you all in the audience are like, who worked on that bail-in letter, or who worked on, you know, this IPO, you can find the people, because people do leave, and then you will have 5 or 6 names of the people who worked on that, and then you can see, oh, they're still there at the staff. So it's giving credit where credit's due and making people enjoy their jobs more.
Thank you.
Thank you.